Right now, there's a strong upward trend on the chart. The price is climbing without any pullbacks, the momentum is almost maxed out, and at this moment, our tool is showing nearly 100% probability of a trend reversal. Imagine you catch this signal right on time. You enter a short position, set your stop loss just above the nearest high, and your take profit is about 1.5 times your risk. The result is a confident close of the trade and profit. In the second scenario, the picture's reversed. The price was falling, but the oscillator signaling again that now the probability of an upward reversal is 89%. You go long, set your stop below the nearest low, and your target is 1.5 times your risk. And once again, you calmly close the trade and profit. In this video, I'll show you in detail what this indicator is, how to properly add it to your chart, what settings to use, what its probability zones mean, and how to combine it with confirming filters to build a simple, repeatable, and logical trading system. The indicator is called trend reversal probability, an oscillator that estimates the likelihood of the current trend reversing soon. Its strength lies in the fact that it doesn't try to predict every tick. Instead, it measures the duration of a trend, assesses how overheated the move is, and translates that into clear numerical probabilities. This is especially important when a trend has gone on for too long. Most indicators either lag behind or throw out false signals at such times. Here, though, we can actually see how likely it is that the impulse will end, not just whether a candle looks good. This approach helps filter out noise, spot extreme market conditions, and prepare an action plan in advance. Let's open TradingView. Any liquid instrument will do. For demonstration, let's take ZUSDT on the 15-minute time frame, for example. You can choose your own. Open the Indicators tab, type Trend Reversal Probability in the search bar, and add this indicator. It's ready to use right out of the box, but we'll go over exactly what it shows and which parameters are worth adjusting. At the bottom, you can see the trend histogram. Green bars indicate an uptrend phase, while red bars indicate a downtrend phase. The higher the histogram goes, the longer the current phase has lasted. This is a simple yet visual way to assess trend exhaustion. Probability zones, based on statistics and standard deviations, are overlaid on the histogram. These are what turn guesses into a concrete probability assessment. The indicator uses several key levels that define the gradation of risk and probability. 14% means a low probability of reversal. The trend is still fresh, so usually there's a little point in trying to catch a reversal. 50% is the midpoint, a normal trend state with a moderate probability of reversal. 84% signals an increased readiness for a reversal. The trend is clearly losing steam, and the probability of a direction change is increasing. 98% means a high probability. At this point, the market is often already overheated. 99% is the extreme zone where the probability of a reversal is almost statistically guaranteed, and this is exactly where the oscillator is especially useful for making decisions. Important, the indicator speaks in terms of probabilities, not guarantees, so we combine it with additional confirmations, which we'll discuss a bit later. Let's move on to the settings. The main parameter is the oscillator length, which is set to 20 by default. If you increase the length, you'll get smoother, more mature signals with less noise, but with a bit more lag. If you decrease it, the signals will become more sensitive and faster, but there will also be more false triggers. You can also turn probability lines on or off and change the histogram colors to visually distinguish risk zones. For basic use, the default setting works well. Later, you'll be able to adjust the sensitivity to fit your time frame and instrument. Under the hood, the combination of smoothing similar to a moving average and momentum measurement is conceptually close to RSI transformations. The indicator estimates the typical duration of directional movement, calculates the standard deviation, and as the histogram moves into extreme zones, it shows the probability of an imminent phase change. It turns out to be a kind of barometer for overheating. The longer the market moves in one direction, the higher the chance that a reversal phase, or at least a correction, will start soon. We're not guessing whether the move will happen now or in 3 candles. We're working with a probabilistic picture, and that's a more honest approach to the reality of the market. To avoid chasing every hint of a reversal, we use a simple logic. When the green histogram rises to 98 or 99%, we consider the bullish impulse overheated and get ready to short, but we wait for confirmation. When the red histogram climbs to 98 or 99%, the bearish impulse is overheated and we get ready to go long, again waiting for confirmation. By confirmation, we mean a color change in the next oscillator bar, a candlestick signal on the chart, like a clear impulse in the opposite direction, and a trend or volume filter. This reduces the number of false entries and turns the idea into a system. For filtering, I recommend adding the MACD. For a long position, we want to see a green MACD bar or a bullish crossover of the signal lines. For a short, it's the opposite, a red bar or a bearish crossover. It's also helpful to watch the volume. True reversal points are often accompanied by abnormally high volume compared to the last few bars. Support and resistance levels are also great for additional validation. A reversal that coincides with an important level is statistically more reliable than a single spike. Here's a clear step-by-step scenario for entering a long position. First, the oscillator is in the red phase. This means a downtrend. Second, the histogram reaches 98 to 99%. The bearish impulse is overheated. Third, the first green bar appears on the histogram, an early sign of a phase change. Fourth, a bullish candle with a more or less significant body forms on the price chart, not just an empty doji. Fifth, the MACD confirms a setup, a green bar or an upward line crossover. In this case, it's a green bar. Enter the long position at the close of the confirmation candle. Set the stop loss just below the most recent local low. Take profit with a risk-reward ratio of 1.5 or 2, especially if you see a strong impulse or increased volume. This approach removes emotionality from trading. You enter after confirmation and exit based on a predetermined ratio. This trade was profitable. Now, here's the opposite scenario, entering a short position. First, the oscillator shows a green phase and uptrend. Second, the histogram moves into the 98 to 99% zone. The bullish impulse is overheated. Third, a red bar forms on the histogram. This is the first signal. Fourth, there's a bearish candle on the chart with a certain downward movement. Fifth, the MACD confirms it, a red bar or a downward crossover. In this case, it's a red bar. Enter a short position at the close. Set your stop loss above the nearest high. The target is 1.5 times your risk, or twice as much if you see a strong reversal or a sharp increase in volume. A fixed risk-reward ratio keeps you disciplined. You're not guessing where to close, you're simply following the plan. As we can see, this trade was profitable. The take profit was reached. Additional options for managing your position? If after entering, the market immediately moves in your favor and covers your risk amount, you can move your stop to break even. This reduces those psychologically tough moments when it almost worked out. Partial profit taking? When the price reaches your risk amount, for example, close half your position and hold the rest until you reach a risk/reward ratio of 1.5 to 2, or until you get a reverse signal from the oscillator. Neutralizing false starts. If the price gives a small impulse and then returns to the entry zone without making progress, don't average down into a loss. It's better to wait patiently and disciplined for a new confirmed signal. News and volatility. 10 to 15 minutes before news releases, reduce your position size or skip entries altogether. During news events, the likelihood of random price spikes is higher. Practical tips on timeframes, instruments, and testing. On lower timeframes, 1 to 5 minutes, set a shorter oscillator length. You'll get more signals, but be ready to use strict filters. MACD, volume, moving averages, levels. On medium timeframes, 15 to 60 minutes, the default settings work great. There are fewer signals, but the quality's higher. On higher timeframes, 4 hours, 1 day, the oscillator shows rare but strong reversal probabilities. It's better to combine it with daily levels and the fundamental background. Be sure to backtest on your chosen instrument and timeframe, then do a forward test on a demo account or with minimal volume. Don't expect a magic button. The strength of the oscillator lies in statistics and discipline, not in guessing. It shows you where the odds are in your favor. The rest is up to risk management. So the trend reversal probability is an oscillator that translates the feeling of an overheated trend into numbers, 84%, 98%, 99%, and so on. It helps you spot extreme market conditions, prepare for reversals in advance, filter out noise, and build clear entry and exit rules. Combine it with MACD, volume, moving averages, support and resistance levels, and so on. This way, you increase the reliability of your entries and reduce the number of false signals. And as always, this is not financial advice. Always test your strategy. Adapt the rules to fit your style, keep a trading journal, and manage your risk. Then the statistics will start working in your favor. If you found this video helpful, please like and subscribe. There are plenty more strategy breakdowns, indicator reviews, and practical setups ahead. Thanks for watching, and happy trading.